Good afternoon and welcome to the Coinbase Institutional Markets Call. It is Tuesday, the 28th of May. My gosh, we're almost into June already. Summer is almost upon us here in the US, and we have a fantastic call lined up for you today. We are going to be running through a lot of ETF-focused topics. Obviously, we had the announcement on Thursday of last week, and we're going to hear from the team about that from a number of different angles. We are very lucky to have Rachel Ziv, one of our senior financing traders, joining the call today. Rachel, welcome. It's the first time you're going to join us, and we'd love to know a little bit about your background and what brought you to Coinbase.
Sounds good. Thanks, Ben, for having me. So I've been at Coinbase almost 2 years. Time flies. Prior, I was in TradFi for 18 years at various banks within the prime brokerage business, so mainly in the securities lending Delta One sales trading teams. I came to Coinbase because I, wanted to bring TradFi products and, platforms to crypto to make it easier for traditional, asset managers, hedge funds, clients to be able to deploy their strategies in crypto. And I'm excited to be here and, rolling out great products for everyone to use.
Well, great. We're very happy you made the loop, and we're very happy to have you here. And we'll hear more from you later on about kind of financing rates and especially around the ETF. But thank you very much for joining.
Sounds good. Thank you.
Also on the show, we're going to be covering politics and how that's playing a much larger role in our space, and also how we as an industry are playing a larger role than we perhaps expected around the election this year. We're going to cover a couple of updates to both Solana and Ethereum from a more technical perspective, and then also some upcoming catalysts. But if you are listening on podcast, don't forget to check all of the fantastic information in the show notes. If you are watching on YouTube, you can scan that QR code in front of you now, and you get access to all of the team's fantastic research and other relevant links from the show today. And no matter where you're listening or watching, don't forget to hit that like and subscribe so more people can hear about the show and learn about crypto. So we can continue to spread economic freedom. But without further ado, let's get into the show. So a ton of excitement with the ETH ETFs approved last week. And now the next question is, when are they going to start trading and what is the order of events around that? So DD, can you give us a bit of background? Remind us, it's been a long time since the BTC ETFs were approved. So what happens next and what sort of timeline can we expect?
Yeah, to be honest, Ben, I don't think we really know when these are going to start trading. And the process is slightly different from the spot Bitcoin ETFs. We mentioned this last week, but there are actually two parts to the approval process. So you have exchanges like the New York Stock Exchange and NASDAQ, which actually need to file the rule changes, and 19B4 filings to actually allow these new products to exist on their platform, or changes to exist on their platform. So that's what was done on Thursday. So effectively, what the SEC did was approve 8 of the 19B4 filings. But you then also had the S1 registration statements from the ETF issuers themselves, and that deals with the prospectuses. And the prospectuses explain how the funds are going to be managed, how they intend to track the performance of ETH, for example. And technically, there's no deadline for approving these S1 documents. The 19B4 filings are what actually had that final deadline, in this case for Van Eck, on May 23rd, that was extended up to 240 days. So I think the concern right now is that this delay is, of course, going to affect potential flows in the very near term, because without an ETF actually being traded on the exchange, you're not going to get the flows, which does, of course, go to ETH. But I think that still the decision itself is perceived as unequivocally positive for the asset class. I think it should support overall performance. And that's also because we've gotten some very important regulatory developments as of late that I think have also been fairly supportive for crypto.
So I guess in summary, we could see them trading tomorrow, or we could see them trading in 3 months' time. And really, we just have to kind of keep an eye on SEC website. And I'm sure we'll hear from the issuers as to when they may actually go live. I think there's almost an argument there that the longer that some of these issuers have to market these new ETFs, actually that might be a positive, and that we can start to educate people on why you might hold the ETH ETF, and maybe you see slightly larger amount of outflows from BTC into ETH, and then also new money going into Ethereum as well. So I guess there's some pros and cons there. But like moving on to demand, George, we'd love to bring you in here. when we compare these to some of our analog comparisons, or I say analog comparisons, maybe just other comparisons, so the Hong Kong ETFs, Canadian ETFs, futures and perps, like how can we think about those from a demand perspective?
Yeah, for sure. I mean, like as you say, I mean, you just look at all of these other products that we have and look at the ratios between the ETH product and the BTC product that they have. So one example is one of the things that I looked at is, for instance, before the Bitcoin ETF launches, GBTC versus ETH. So GBTC in early January this year had about 28.9 billion versus ETH 7.3 billion. So that was a ratio of around 25%. So would if we look at the total net Bitcoin ETF inflows so far this year, we're now at just shy of 13.7 billion net inflows. That would put the potential ETH number at around $3.5 billion. If you look at CME open interest in ETH, that's now at around 1.2 billion. That's also doubled over the last week, so that's important to note. Bitcoin CME open interest has been a little bit more stable at around $10.8 billion in aggregate. So get a ratio of around 11% here. Now, with CME open interest or open interest in general, I'm not sure if that's a great comparison because there's a lot of moving parts here. For instance, I think folks had the ETH E-Trade on, probably some had hedged with the CME ETH futures. There'll be some basis trades on using the ETH futures and so on. So again, there's a lot of moving parts. But if you look across to Canada, for instance, and let's say you take the Purpose Bitcoin ETF, that has a ratio of 21.4%. Most of the other Canadian ETFs are also around that 20% ratio between ETH and Bitcoin. And looking across to Asia and Hong Kong, if you take China AMC's ETFs as an example, ETH is around 17.6% of the market cap of the Bitcoin product they have. So long story short, to summarize, I think 10 to 25% of BTC net flows is an estimate for the amount of flow I'd probably expect in ETH, maybe even 15 to 25%.
Interesting. So if we base that off $60 billion of BTC ETFs right now, we're looking at somewhere between like $6 and $10 billion. Does that feel fair?
Yeah, that sounds fair. Exactly.
So we'd love to bring in David Hahn here and just talk about the supply side. We've covered demand. We kind of have a rough idea of where it could get to. Clearly, the estimates for the Bitcoin ETF were way undershot. So it'd be lovely if we were in the same position in 3 months' time with Ethereum as well. But on the supply side of things, David Hahn, how are you thinking about that?
Yeah, the supply side for ETH is a very interesting question because it's quite different from Bitcoin. If you pull up the chart, I'll kind of walk through it. What we've seen with ETH supply on chain is that a very big portion of the active ETH supply is actually being staked. So in the previous run-up when ETH was still doing proof of work, and very little people were staking it on the Beacon chain, you see the active supply of ETH go up, the active 3-month supply of ETH go up. When the price goes up, it drops when the price goes down. And as pretty much as there's more volatility, there's more and more people trading ETH on chain. What we've seen this cycle so far is that the number of unstaked ETH has actually been suppressed the entire time. We've seen more and more ETH being staked. Right now, we have around 27% of ETH being staked, which is a very, very big portion of just the active supply of ETH. Now, one thing to note about these ETH ETFs is that all the ETH that they have is going to be unstaked. So typically, if I'm looking at structural supply side stuff, I'd be very carefully watching the staking percentage, the amount of ETH staked. I don't think that I think if you're going to see a lot of like structural selling, it'll be from a lot of these ETH sellers who might have held ETH for several years and who are trying to offload. So I think that's one thing to watch. I don't know if we'll see very much of that, and I think there could be a little bit of supply side constraint, much more so than Bitcoin, for example, where you see a much clearer pattern of long-term holders moving their Bitcoin during price rises. So that's one thing to be aware of, which is this ETH supply staking. Now, I guess on the other hand, as well, it's going to be the ETH rotation into maybe other ETFs, like we saw with GBTC outflows and net inflows into IBIT or Fidelity, FBTC. So we might see some of that happening. I think some estimates have said that we might see up to $100 million of daily outflow in ETH. I think that number may be hit in the first few days, but I don't know if that's going to be something we're going to see in the sustained long term. I don't know if I don't think there's as much bankruptcy overhangs and other liquidation events for ETH relative to GBTC, just in terms of overall asset size, etc. That said, I do think that one big question I have internally is kind of the demand side, how much net inflows we're going to have, given that a lot of the people who are exposed to or who would like exposure to ETH, a lot of the native players would want that staking yield. And a lot of the more, I would say, advanced players also have access to, for example, places like Coinbase ourselves, where they can get the staking yield, whereas on the ETH ETFs, you won't have that. So it's a big question of how much demand you're going to have versus how much supply of a constraint you're going to have on the supply side. And I think that these dynamics are still quite up in the air, given that these ETH ETFs had not had as much time to be marketed out to clients, given there's uncertainty around approvals. And so there's a lot of different areas to balance out right now.
Yeah, I agree. It's tons of variables, and it's tough to kind of have a very clear path on how these things trade. Interesting in conversations this week with some institutional clients, some are talking about the fact that 27% of ETH is staked, and the circulating supply is lower. And sometimes ETH can be a little less liquid when trading, there's a chance you see a bit of a squeeze in ETH prices, and that then moves across to some of the other assets, which are slightly further out on the risk curve. But it's just so hard to know when you just have no idea what the demand is going to be like, because it's a very different story to Bitcoin for sure. Now, would love to bring in Rachel here. Rachel, welcome to the podcast. It's the first time I've had you on, so it's so lovely to have you here.
Thanks, Ben. Great to be here.
And would love to get your sense from the financing side of things. You guys obviously have a great viewpoint on what a lot of our institutional clients are doing when it comes to financing. So what's going on at the moment specifically around sort of the ETH as an asset?
Yeah, I think firstly, it's important to look at the borrow dynamics of ETH, considering crypto's immediate settlement, and we're going to need ETH inventory for execution purposes and for clients to be able to trade without pre-funding. So ETH borrow dynamics are very different than Bitcoin. As David mentioned, 27% of ETH supply is staked. So we don't have as much liquid ETH for financing purposes as Bitcoin. The ETH staking rate has been stable in the around 3.5% range. And I would say a lot of crypto native holders are more comfortable with staking risks versus lending, counterparty credit risk. So we do see a lot of them leaning more towards staking versus lending. I would also say as a result, ETH is less liquid in the borrow market versus Bitcoin, but we are confident and we do feel that we have enough ETH inventory to handle the ETF flows that we expect to see. So in the borrow market, spot rates on ETH have been, mid to high single digits. They've been stable there, and we expect them to remain stable there. In contrast, Bitcoin is low to mid single digits, more liquid, but they have remained stable from the ETF launch earlier this year. So that's really like the specific financing rates on the ETH and Bitcoin around the ETF flows. I would say, more generally, we definitely saw an increase in leverage, over the past few weeks, especially after we saw the ETH approval expectations shoot up at the beginning of last week. Our USD/USDC borrow book is up around 35% from the lows earlier in May. So good to see more clients getting active again on that front. And I would also say we definitely saw some clients using our trade finance product, which is borrowing dollars to buy ETH without pre-funding that, but not nearly as much as leading into the Bitcoin ETF launch. And I think there's probably a few reasons for that. I think, some TradFi funds may not have ETH in their mandate yet. They may just have Bitcoin. I think also the basis was a lot wider leading up to the Bitcoin ETF approval versus, now with ETH. And I think finally, this was a quick pivot in, I think it was like 20% approval chances we saw shot up to 70% beginning of last week. So it was just a few days before the SEC actually approved the listing of the ETH ETFs versus Bitcoin. I think it was expected for a lot longer period of time before January.
Yeah, that makes a ton of sense. I'm curious, you mentioned in your commentary that crypto natives are more comfortable with staking risk versus lending risk. As this market institutionalizes, so more institutions come in and they buy ETH, probably not via an ETF, because ETFs aren't going to lend it out necessarily on day one, but How do you think that's going to change the market? Do you think you're going to get more institutional participants that maybe get more comfortable with lending and that lending market gets more liquid?
Yeah, definitely. And we're already starting to see that. I think any TradFi clients that understand the agency lending business and equities and fixed income markets, I think are very comfortable and understand the counterparty credit risk of lending. And we've already seen those clients that have entered crypto markets be comfortable onboarding for our digital agency lending product. And we do expect to see more of that in the future. I think also as we go to educate crypto native funds about the different risks between lending and staking and potentially diversifying those risks and doing a bit of lending, a bit of staking with their portfolios, I think that we are seeing some success there as well.
Amazing. I'm curious. So when you're speaking to clients about that, about diversification between lending and staking, how do you break down the pros and cons of both?
Yeah, so I think the main thing about lending, which we think is a big pro, is how liquid it is. It's a 48-hour SLA recall, and generally, if the clients are pulling back their assets, during the week, business hours, it's even quicker than that. So very liquid to be able to lend your assets, pull it back at any time. I think from our perspective, we're really building a diverse book. So lending book. So we don't have to necessarily pull from the borrower when a lender is recalling their assets. We can go replace it from another lender. So we're very comfortable that we've have a very diversified book and we've covered that risk. So I think just trying to explain that to clients, how liquid it is. Of course, there's a counterparty credit risk, but everything is over collateralized. So clients are secured that they will receive USDC over collateralized from us for lending their assets.
Got it. That makes a ton of sense. Thank you, Rachel. Now, fun question. David Duong, what is next? There's been various talk of Solana and XRP ETFs. Some have mentioned Doge, Bitcoin, Cash, Litecoin, etc. Which one or not do you think could be up next?
Yeah, I love the space. We haven't even gotten info data on spot ETH ETF, but we're already looking ahead. Or maybe I guess that's just what market players do. So I would say that there's been some doubt cast on whether we would actually see a potential ETF around Sol or other altcoins. I would actually join them. It feels odd for me. I don't usually enjoy that kind of company. And in this case, I think it's JP Morgan. And so, it goes back to my TradFi days. But I would say that I'm skeptical that we're going to see another ETF surrounding one of the altcoins just in the very short term, because I think there's a lot of regulatory scrutiny around, for example, Sol as a security compared to ETH, whether or not that's deserved. A lot of these altcoins just haven't been around as long as Bitcoin or even ETH. The market size is much smaller. For example, in Solana, the $76 billion market cap is just 3% of the total crypto market cap, whereas Bitcoin dominance at 53%. Even Ether dominance, it's down a little bit from where it was a year ago, but it's at 18%. So just with those two tokens alone, you just capture 3/4 of this market. And I feel as an issuer, generally you're more incentivized to just kind of capture and try to win the majority of the market. Whereas they may not be as incentivized to issue a Solana ETF, for example, because a lot of these issuers just can't really tolerate negative PR and they can't tolerate low flows. And if they're worried about that, then that's going to impact their bottom line. They're not going to be able to sustain themselves. So, I'm saying this with the assumption that we don't know if FIT 21, for example, is going to become law. It just passed the House, for example. But we do have this, path that will go towards defining whether something crypto is a security or not, who has jurisdiction over that crypto asset. But that's a very different story. I can't predict whether that's going to happen yet. And even in things like the Ripple case, for example, it was only a narrow definition where it didn't qualify as a security. If it was, for example, sold on a public cryptocurrency exchange, then it didn't meet that legal definition. But we really don't know for a lot of the other assets. So, I would say that maybe if we start answering questions about staking and other things, if we see the SEC kind of change its perspective, maybe that could then kind of change my mind. But for the time being, I just don't really see that we're going to have another ETF on one of these altcoins.
Got it. So nothing for 2024, but you never know in 2025 or maybe 26. Who knows? I guess, David, breaking it down into maybe its constituent parts. Like, what do we need to see for this to become possible? So a lot of Bitcoin and ETH is around having a future at CME. You mentioned around security classification. That's obviously an important one. I guess if there's a tick box for things that we need to see in order for some of these assets to be more eligible, what's on that list?
Yeah, I mean, the security issue is probably where there was the most ambiguity. And so I think that, for the SEC to already approve spot ETH ETFs, I mean, that's a big deal for them. I think they were already fairly stretched when it kind of came to trying to define those things. But I would say that typically we do see that as a first step. You see futures approved first. Now, I think we were talking about inflows previously. We have to recognize that the inflows into like US ETH futures ETFs back in October 2023 did come in below expectations. So the reception wasn't particularly warm, which again, it kind of goes back to it's not just about whether we want these things to happen. It depends on whether the issuers believe that there is a market for this and that they can sell into this market. So the fact that even the ETH futures ETFs didn't necessarily do super well, it might give a lot of those issuers pause as to whether they should expand into other assets.
Got it. That makes sense. So you and David were kind of spot on with these ETH ETFs around the approval. So I'm gonna bring in DH here to just like try and get a more positive stance on when we might see another ETF. No, I'm playing. But David, I'm curious. David Hahn, I'm curious how you think about this as well. Kind of approval rationales.
Yeah, I think I have a similar conclusion to David Duong. I think I pretty much agree with everything he says. I think one other note I would like to add on top of that is if you look at the SEC's original rejection rationale for Bitcoin ETFs historically, a big part of that was around concerns around market manipulation, market sizing, and ultimately the reason why we even had the correlation test in the first place between CME futures and spot Bitcoin on Coinbase and Kraken, and the same for Ethereum as well, is because the idea is that if the SEC and the CME have approved market surveillance for the futures, then the spot should also, if they're closely enough correlated with the futures, then there should also be a less market manipulation or any possible acts of fraud on the spot markets. So I don't know if we're going to be able to see that or meet those kind of anti-market fraud thresholds that the SEC has set. I mean, these thresholds are not very much set in stone. Clearly, I think that the history has shown us that the SEC might be reluctant in approving other ETFs unless there's a clear case to do so. So what we might have to see as well is a new rationale for the SEC to approve other crypto ETFs outside of Bitcoin and ETH, and also or different types of regulation that provides more clarity for this kind of approval process when it comes to preventing acts of manipulation or purported acts of manipulation.
Okay, we'll come to maybe some of the legislative changes in a second, which might support that argument. And before we do, George, just checking in on derivatives, like how are we looking now in ETH derivatives, so options, futures, perps, etc.?
Yeah, for sure. So obviously talked a lot about the news and demand there, but looking at it from a more, let's say, trading angle now, with the rally in ETH over the last week, the aggregated open interest in ETH is now up to a new all-time high. So to throw some numbers at it, we went essentially in the space of a week and a half from $8 billion to $13 billion in aggregate open interest in ETH. So it's quite significant. CME open interest, as I mentioned earlier, has doubled. So that kind of shows, I think, that the inflows into ETH were both driven by spot, so capital that was on the sidelines, as well as leverage. And I think while it's definitely super bullish that we are getting the ETH ETFs and spot positioning is still relatively low, I would say. I would also think that it's definitely worthwhile keeping an eye on the leverage in ETH, and that might make the market vulnerable to corrections in the near term, just given the amount of leverage that has been built up. Although obviously, I guess similar to BTC, given the demand for it ahead of the ETF, I think if we do get corrections, they're likely going to be shallow and bought up pretty quickly. On the option side, it's a similar story. You can also see demand for ETH upside. So 25 delta skew, looking at the 30-day is a good way of looking at that. So essentially, just looking at your difference between the implied volatility on calls minus puts, and a positive number would indicate that you have upside demand, and a negative number the opposite. So looking at ETH. We have been trading in the negative area, looking at the 25 delta 30-day skews pretty much until mid-May, and then obviously done a 180 with the news last week, and we're now trading at +6 actually, which is even slightly higher than where we are with BTC at +3.
Interesting. Perfect. Thank you for that rundown, George. Now, a second ago, we mentioned politics being perhaps an interesting catalyst to these approvals. David Duong, would love to kind of hear your thoughts on that. Obviously, we've got FIT21, we've got SAB 121, and perhaps some other things going on as well. Like, what role is politics playing within this kind of ETF decision and crypto more broadly at the moment?
Yeah, it's interesting because we also have the elections, of course, in the US coming up in November. And it's starting to look like crypto's an election issue. We saw Trump make some very pro-crypto comments over the weekend, for example. He's promised to commute the sentence of Silk Road founder Ross Ulbricht, for example. He's vowed to make the US a leader in the digital assets industry. He also ridiculed Biden's ability to understand issues in crypto. But it's also not just one-sided. We also saw that Biden has made comments on SAB 121, actually taking the other side, that he would potentially veto this. That decision, of course, was supposed to be done on May 28th today, but it's now looking like it's going to be delayed until June 3rd because of some procedural issues. But it does seem like crypto is becoming a pretty important issue, just in general, but definitely for the upcoming U.S. elections. And I think that has to do with a lot of institutional interest around these ETFs that has formalized crypto as its, a definite asset class. So we are seeing that, there was a poll actually funded by Grayscale, a Harris poll, that suggests that 1 in 3 U.S. voters said that they'll actually consider a political candidate's position on crypto before they would actually vote. And, I think that actually had a poll went around like 1,700 people, but there's a lot of interesting statistics around there. 77% think a U.S. presidential candidate should know crypto. 44% of the participants said that they think to some degree crypto is going to be the future of finance. 52% think that there actually does need to be more government oversight. So I think that there is a lot of demand coming here from the electorate themselves, which are also formalizing this as an important issue. So I think what we got last week, not just with the SEC approval of these 19B4 filings, but also the FIT21 Act, and FIT21 stands for Financial Innovation Technology for the 21st Century. We really need to talk to Congress about naming things, by the way, because this does not roll off the tongue. But anyway, FIT21, I think considering how divided this Congress was just a year ago, like I think a lot of people forget, but just a year ago, there were several rounds of people who were voting for Kevin McCarthy as House Speaker, only for him to eventually get ousted. Now, at that time, any contentious legislation just wasn't getting passed by the Congress. Today, you're seeing that something like the FIT21 Act can actually get through the House. I think that's quite a feat. I think that a year ago, they couldn't even avoid a government shutdown without causing a lot of consternation among the voters. And they eventually, of course, raised the debt ceiling. But it was clearly a divided Congress. Now it shows that they can actually accomplish quite a bit. And the fact that this bill has to do with crypto shouldn't be lost on anyone. It shows that there is quite a united front of bipartisanship for people who actually care about crypto issues and want to see this get done.
Yeah, it's amazing, isn't it? I don't think many people at the start of the year would have had that on their bingo card, and it looks set to get even more interesting into November as well. So yeah, certainly one to keep an eye on. I think also within some of that reporting, there was Trump said something about banning central bank digital currencies as well, which could be supportive to the industry in some way, shape, or form as well. So, yeah, still an interesting one to keep an eye on. And if it does remain an issue, we can be sure that it will be talked about a lot, as much as Trump possibly can. So we won't be at the headlines for the next 6 months or so. Interesting. Now, moving on, we had a bit of a movement down this morning when there was a movement from one of the Mt. Gox cold wallets. George, do you mind just kind of running through some of that price action?
Yeah, for sure. So essentially what has happened is we had a Mt. Gox related wallet, as you mentioned, that hasn't seen any movements in about 5 years. Move around 107,000 BTC, so approximately $7 billion at the time. So obviously it does seem like the first distributions appear to be underway, which was the reason for the sell-off we have seen. Now, I'd say the important thing to keep in mind here is that receivers had a choice between dollars and receiving the actual coin. So it is quite likely that the majority of those who wanted out probably would have opted for the dollars. So because of that, I think, to a large extent, likely it's already priced in, I would say, and even, if there was a proportion of those who will receive their coin, the Bitcoins in the end, it's not particularly likely to cause any major market impact. Just to put the numbers into context, for instance, just over the course of last week, we had about $1 billion in inflows into the Bitcoin spot ETF products. And there are obviously other sources of demand as well. But it's definitely worth keeping an eye on that.
Yeah, it's interesting. To your point, it's 142,000 BTC, which is somewhere sort of $16-17 billion worth in total. And then obviously we've got the FTX money coming back at some point in Q3, Q4. I guess, can you just talk to some of the dynamics around those FTX claims right now? Where are they trading? And maybe of that, I think it's somewhere between $16 and $18 billion that comes back. How much of that could we see going back into crypto potentially, do you think?
Yeah, for sure. So, I mean, the last question you asked there, it's quite difficult to answer because obviously a lot of folks would have sold their claims to funds that are just waiting for the distribution, as you say, which is probably going to come at the earliest, I would say Q3, maybe Q4, maybe Q1 next year. So that money is probably not going to re-enter the space, right? But having said that, there is obviously a proportion of that whole estate, right, of crypto natives that were involved on FTX, and I would guess that money would obviously enter the space again. Now, in terms of where things are trading, it's always a function of the size of your claim. Typically, let's say if we're talking about a low six-figure claim, then right now, actually, with the most recent news, it'll trade around par. And that's because essentially the FTX estate and their proposed distribution plan has said that folks that had claims up to 50K will be receiving 118% back. And this might take some time, but that's going to be the number. And the estimate that they gave for claims above that, so above $50,000, is something between 127 to 142%. So hence, obviously, it's been trading on the stronger side. But regardless, I do think that, that together potentially with macro catalysts and that extra cash coming back into the space might form a number of quite nice catalysts going into the year end or the beginning of next year.
Yeah, that makes a ton of sense. And just to correct something I said earlier on, so it's 142,000 Bitcoin, which is between $9 and $10 billion, depending on what Bitcoin is trading. And then 50% and then the FTX claim is somewhere between $16 and $18 billion. But obviously not all of that is going to come back. So certainly a lot of credit funds that are in that trade for buying it at 60 cents on the dollar and then trading out at 100 or maybe more as George mentioned. So it's certainly something to keep an eye on there. And George, the deadline for Mt. Gox is October 31st. Is that right?
Yes, exactly.
Perfect.
That's correct.
Okay, cool, awesome. So DH, David Hahn, I want to run through some of the on-chain stuff. One thing just to kind of touch upon here is Notcoin, which is a game on Telegram, recently touched $1 billion of market cap after an earnings mission launch. I'm not entirely sure what an earnings mission is. I mentioned this in the context of Telegram, obviously, is a messaging app with over 850 million users. And it's getting some traction. Some of the games on there are getting some traction as well. But David, would love to kind of hear any thoughts you might have on that, but also an update on Solana and what's going on in that ecosystem.
Yeah, sure. I'll start off with the Telegram ecosystem. I think the Telegram ecosystem is very interesting. Not so much because of the underlying chain or any sort of major technological breakthrough, but I think it represents a big improvement in user experience. And I know we've always been talking on the show at Coinbase about improving and onboarding more users, whether that be through a smart wallet service, social wallets, kind of abstraction, etc. All these things are supposed to make it easier for people who don't want to deal with a seed phrase, don't want to deal with a hard wallet, in order to just get exposure to crypto. And so what makes Telegram interesting is the idea that people are already onboarded into this app. There's an integrated wallet that operates on specifically the Telegram blockchain. Notcoin is probably one of the leading games on that wallet, which you can open up within a specific chat within Telegram. So there's no need to context switch between the Telegram Messenger app into something else. And I think that across the world, you've seen more and more of these quote unquote super apps take off, whether that be like WeChat in China or some of these other apps over the world where they combine messaging with finances with other sorts of apps that have been successful. Less so in the US, but I think it is a very interesting opportunity space just in terms of creating a crypto super app that is integrated into a big existing channel of users.
Yeah, makes a ton of sense. It feels like it's still very, very early in that, and Notcoin is maybe not the most advanced game, but when you have enough people playing it at scale, it kind of gets interesting. But yeah, sorry, back to you on Solana.
Yeah, Solana's been interesting. So recently, the chain, they passed an upgrade which said that all the priority fees, instead of half of them being burned, all the priority fees would go to the validator. So for context, there are two types of fees on Solana. One is a base fee that everyone who submits a transaction has to submit and pay. The other one is priority fees, which says if you want your transaction to be prioritized and put on chain, it will kind of speed up your transaction. And we kind of have a similar breakdown on Ethereum as well. Previously, Solana would burn 50% of all the base fees and also 50% of all the priority fees. Recently, there was a vote, the Solana Improvement Document 96, that voted with a 78% approval rate to actually remove the 50% priority fee burn and pass it to all validators. Now, what does this mean? Well, I guess for the first thing it means is that Solana might become a little bit more inflationary. If you pull up the chart about Solana fees, what you see on screen is in gray is the priority fee transactions for all non-vote transactions, which constitutes around 85 to 90% of all fees spent on Solana. So what you might see is a reduction of about half in terms of the amount of SOL that's burned, just given that half of this is currently being burned. That said, I think that's also less of a material structural market impact. Currently, or in the past week, around 56,000 SOL were spent on priority fees. This is around $4 million of Solana that's burned each week, which compared to billions of dollars of trading volume every day is kind of a drop in the bucket. But what is interesting to highlight is here that Solana's transaction fees, the breakdown, the burns, can be changed with on-chain governance voting. So the way this vote was actually carried out was with staked SOL. You can go ahead and you vote for or against this proposal. Whereas with Ethereum, EIP 1559 or any of these other sorts of changes to these fee mechanisms is done via a social consensus layer with major upgrades rather than single off-chain or single on-chain voting and then being included into the protocol.
So David, I feel like one of the big issues is that we've seen meme coins being such a big activity attractor for Solana as an ecosystem, and priority fees, famously not necessarily getting you anything, much less at the front of the queue. So how does this help resolve that? Or are we still going to have to wait for the next Solana Labs client update before that actually gets resolved?
Yeah, that's a great question. This upgrade is not going to improve the effectiveness of priority fees. My understanding is that priority fees today, whether you have like a 1 lamp port or 10 lamp ports or whatever additional priority fee that you include, it doesn't meaningfully change the probability that you get on chain before other transactions. So there's no fixed transaction ordering on chain. It's still very probabilistic. So priority fees are still not the they still have to be reworked. Also, the base fees also need to be reworked. So there's a lot of things that we might be seeing with Solana in terms of upgrading their fee structure that it's not going to be addressed by this. I think the main reason why this passed is just because of the larger overhead cost of Solana validators, where it just makes validators more cost efficient to run relative to how much it costs for the hardware, et cetera, when you increase the amount of fees that they get from all the transactions that are processed by them.
Now, on the subject of upgrades, also a upgrade for Ethereum, the Prague Electra or Petra, better naming than FIT21. Can you run us through that and how important that could be?
Yeah. So Petra, discussions on the Petra upgrade have been going on for a few weeks or a few months even now since the Denkun upgrade back in March. Now we have a general target timeline, which is for the first quarter of 2025. Note that this is also a very soft timeline. The Ethereum Foundation and some of these other developers have changed timelines historically in the past. But at least now we have a date to look forward to, which would be just under a year from now. I think a few things to look forward to. I know last week we talked about EIP 7702 and account abstraction. So we covered that in terms of how that might allow your current existing wallet to make use of smart contract features. There are other important upgrades, maybe for some developers as well, like the EVM object format, which allows you to kind of version your smart contracts and maybe deprecate old and unused features, whereas currently it's quite hard to do that. Also EIP 7251, which is to increase the max effective balance for validators. Today it's 32, which is why you have thousands and thousands of validators. But it might be easier to reduce the number of validator count, which is better for consensus and network stability by saying, hey, instead of having 100 validators with 32 ETH each, you can have a fewer number of validators and just have a larger number of ETH in your validators. And the last one I want to point out is something called PureDAS. DAS stands for data availability sampling. And this essentially increases the amount of blobs per block. We haven't hit our current peak blob usage post Denkun. If you pull up the chart, the target number of blobs per block is 3. We hit that back in the end of March when blob inscriptions became a very hot thing. They kind of disappeared after a week or two. That said, we have seen the number of blobs used gradually rise. I believe we're around 1.6 as a 3-day moving average per block. This is because Blast has started launching blobs. Tyco, a new rollup, has started launching blobs. So as we get more and more rollups, we're going to quickly approach, or not quickly, but we will approach this target range of 3. And so what PureDAS allows us to do is to pretty much extend the number of blobs per block by sharding the data and storing it across different validators, and then sampling the data on a need-to-know basis, which is data availability sampling. So exciting things to look forward to for Petra. Not everything is finalized again. There's a target deadline, but there's still certain discussions about exactly which EIPs are going to be included. But these are generally top of mind for based on a lot of the previous Ethereum calls.
I'm always so impressed how you managed to remember all the EIP numbers. It feels like there's so many out there, and then of course so many different ecosystems as well. So nice work, and thank you for that update. Now, just wrapping up with a couple of things on upcoming catalysts. So DD, economic data this week, what are we keeping an eye on? And then George will finish with you on unlocks to keep an eye on.
So I'd say the only thing, Ben, is the USPC price index. For anyone who doesn't know, this is the Fed's preferred measure of inflation. And the headline PC is expected to be up around 0.3% month on month. Year on year, that would be around 2.7%. So mostly unchanged from March. And also keep in mind that we already got the US CPI data. So probably, I think most people are already paying attention to that. And, we've already priced in the trajectory. So unless PCE really kind of surprises in one direction or the other, I don't think it's going to move markets. But core PCE is still going to be relevant, and it's expected to be up 0.3% month to month, 2.8% year on year. But that would be in line with March for the most part.
Perfect. Thanks, David. And George, unlocks. Any big ones we should be aware of that might be affecting the prices of assets in our space?
Yeah, sure. So as Greg mentioned a couple of weeks ago, and coined the term the year of the unlock for this year, I think this week is definitely going to be on track for that. So a couple of unlocks worth keeping an eye on. So we've got OP with around $80 million, DYDX $70 million, SUI $72 million. And then the last two, ENA, $48 million this week unlocking, and 1inch, $41 million as well. So obviously a lot of scrutiny on token inflation and token unlock schedules. So I think the pressure is going to remain there on pretty large parts of the altcoin segment. And I think that probably helps to explain why blue chip meme coins continue to capture so much mind share in the space. And that's probably not going to change in the near term.
Interesting. And we have GME trading up aggressively as well. And someone else sent me one of the electric car makers that I think Faraday was also trading pretty aggressively higher. So yeah, there certainly feels like a bit of action in that sense as well. Perfect. Awesome. Well, thank you very much for that, George. Thank you, Rachel. Thank you, the Davids. Fantastic, all of you as always. And thank you for listening in. Have a great week, and we will see you this time next week. Take care.